Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a strategy that we have not covered here before, which are straddles and strangles. And I'm specifically referring to selling straddles and strangles. We're not here to talk about buying straddles and strangles because that is a strategy that is almost an entirely losing proposition in terms of buying straddles and strangles. There is almost virtually no way to make money buying straddles or strangles long term. Are there individual opportunities to make profits on that? Sure, but over the long run, it's a strategy that almost is impossible to make money from. So we're talking about specifically shorting straddles and strangles. Now, this is a more advanced strategy. Number one, it requires options level 4 or 5, depending on what brokerage firm you trade with. It requires a high amount of margin in terms of capital to enter one of these trades. So it's not for trading accounts that have $2,000, $3,000, $5,000. And it is a strategy that has truly unlimited risk. If anyone's been paying attention here to the markets, to strategies like the naked shorts that hedge funds have taken on GameStop, if you had shorted a strangle on a stock like GameStop, you would be suffering the same kind of losses as those hedge funds would have unlimited losses to the upside. So this is not a strategy that's for someone who's starting out. It's certainly only for strategies that are typically first of all, clients with larger accounts, more sophisticated understanding of options. And generally, if you're trading these, we'll talk about what type of stocks or ETFs you might want to sell these types of strategies on. So let's go ahead and get started. Before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. And so we'll start off by talking about straddles, and we'll introduce strangles. The two are very similar to each other, but there are some slight differences in terms of the option Greeks. So we'll talk a little bit about what the differences are of those option Greeks from both straddles and strangles, how they differ from each other. From a mechanics perspective, the two are very similar, but they have very different optimal strategies in terms of how do you go about managing them? When do you go about taking profits? When do you go about cutting losses? How do you go about rolling them and trade management? They're quite different from each other from that perspective. And then at the end, we'll open this up for Q&A. So again, we're only talking about short straddles and strangles here. And the primary question that I want to help investors answer today is really why are short straddles and strangles even traded by investors if they truly have unlimited risk? We usually talk about options as a strategy to limit risk. I think that's really a big part of what I teach here at OptionsPlay is how you can leverage options to take directional views or views in the broader markets and do so in a way with limited risk. This is one of the few strategies that we'll talk about that truly have unlimited risk. And you must understand the risk that you're taking with this type of strategy. So it's not for someone who's starting out. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And what I want to share with you today are the optimal strategies around selling option premiums like this, why professional investors love this type of strategy despite the fact they have unlimited risk. And for those of you that are starting out with options, if you're learning and you're trying to find some new strategies and you're trying to get some ideas as far as how you can utilize options in your portfolio, one of the ways that you can do so is by watching CNBC every single Friday at 5:30 p.m. There's a show called Options Action. Me, Mike, and Carter are on that show every single week where we present to you 3 ideas on a stock or an ETF. We'll lay out as far as what our directional view on that stock, ETF, or sector or market is. And then more importantly, we'll show you how we leverage that view using options. Now, we'll typically not look at selling straddles and strangles on CNBC because, again, it requires a high amount of margin. It has unlimited risk. Those are typically not the type of strategies that we would talk about to the general public. We usually talk about strategies that all have limited risk, but today I am going to explore to you a short straddle and strangle, which is again a more advanced strategy, but has certain benefits. So let's just talk a little bit about what a short straddle looks like. I'm going to use a fictitious stock to start off with, and then we can look at some real stocks as an example using OptionsPlay. So first of all, just to define the strategy itself, a short straddle and a short strangle are used when you have a neutral view on an underlying stock or ETF. So not like buying a call or a put when you're bullish or bearish, it's for a stock that you think is not going to move very much. And we'll talk a little bit about how you go about finding stocks that you don't think is going to move very much, and what are the metrics you can gauge to get a better sense for when a stock may not move very much. So when you have stock XYZ trading at $100 and you feel that the stock's not going to move very much over the next week, 2 weeks, 3 weeks, one of the strategies that you can trade is a short straddle. Now, a short straddle would consist of selling a call option and a put option at the exact same strike. So if the stock is currently at $100, I would sell an at-the-money call. I would sell an at-the-money put. Let's say for the call option, I collect $4 in terms of a credit. I sell the $100 put for $4 credit. In total, what I'm going to do is I'm going to collect $8 in order to sell the straddle. Now, the premium that I collect from the straddle, that is the buffer that I get from the strike price that I sold the straddle at which the stock cannot exceed that amount in order for me to break even. So what you have here is a strategy that has a limited reward. Just like when you short a put or short a call or sell a credit spread, whenever you're selling an option strategy, you always have limited reward. In this particular case, normally if let's say I was neutral on this stock and I just sold a $100 put option, my reward is limited to $4. Now, because I sold the put and the call, I've effectively doubled my potential reward here from $4 to $8. And for that, I'm taking on unlimited risk. Now, when you sell a put option, the stock can't go below zero. So your risk is limited to, in this particular case, $96 a share if you had just sold the put. If you sell just the call, this side, you do have truly unlimited risk, because if the stock keeps going higher and higher and higher, you're going to lose more and more money. So you're really taking on the risk of one side in exchange for the premium on both sides, because the stock can't be below this level and above that level at the same time. It has to be one or the other, right? The stock either can drop very much or it can rally significantly. Those are your two possibilities beyond the stock simply staying within a neutral range. So if the stock moves very little, stays within this range, which in this particular case is between 92 and 108, that's when you'll be profitable. If it exceeds that range below 92 or above 108, that's when you have losses. And the further the stock moves away from that $100 strike price, the more you have to lose. But again, when you just sell a put option, all you have is a $4 buffer. When you sell a straddle, you now have effectively double, an $8 buffer. So that's the role, if you will, of why someone might want to sell a straddle versus selling a naked call or a naked put, because you are effectively taking on very similar risk profile in exchange for double the amount of premium or the double amount of buffer that you have before the strategy is profitable. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you as far as just the general structure of this strategy. Okay, so what I want to discuss now a little bit as far as that, I think everyone for the most part understands this strategy, but the challenge with this strategy is the fact that it requires a high amount of margin, because what you have to account for is the margin requirement to sell this $100 put, the margin requirement to sell a naked $100 call option against it. So generally speaking, the margin requirement on a short straddle or a short strangle is the greater of the two sides' uncovered short margin. So if you calculate the margin requirement for a naked call, the margin requirement for naked put, whichever one is greater, plus the premium of the other side, that's how you get the margin requirement of a short straddle. So generally speaking, for a $100 stock, the amount of margin that's going to be required to sell that is going to be somewhere in the 20 to 30% range. So if you sold a $100 stock naked put or naked call, you're going to have roughly about $1,800, $2,000 in margin for that. Here, you're going to need a little bit more, about $2,000 to $3,000. Now, this generally depends on the volatility of the stock. The more volatile the stock is, the more a margin requirement you're going to need on that particular trade. So let's talk a little bit about the strategy and as far as what you're actually doing when you're selling a straddle. And to do that, we have to understand a little bit more about the option Greeks. So when you're selling a straddle, what you're effectively doing is you're selling both the call and the put. Now, when you sell a call or a put, you're effectively short volatility. You're short the Vega. And when you short a straddle, you're effectively doubling the short volatility aspect that you have in this particular strategy. The other thing that you have working in your favor is short theta, because time decay works in your favor when you're selling an option. In this particular case, what you're getting is double that time decay, right? So instead of just selling a call option and collecting the premium for that, you're selling a call and a put, and you're collecting premium on both sides. And because you're selling a call or a put at the current price of the stock, this strategy is actually delta neutral initially. Meaning when you sell, let's say, a 50 delta call and you sell a 50 delta put, the call side has a positive 50 delta, or rather negative 50 delta rather, because you're selling it, and the put side has a positive 50 delta because you're selling the put, and the two offset each other to basically, so on the put side, you're basically long 50 deltas, on the call side, you're short 50 deltas, so the two offset each other to effectively be delta neutral. So your net delta on this particular trade is effectively zero. However, as the trade, if the stock starts to drift, if after you sell the stock, sell the straddle, and the stock starts to drift either higher or lower, this is really where you start to get delta exposure. So the goal of a short straddle is so that the delta exposure that you have, meaning the drift in the underlying stock, what you want to do is make sure that the stock doesn't drift too far, or else what you're going to lose to delta is going to overcome what you're gaining on the short volatility and short theta side. So for any one of you that's here on this webinar, if you feel that I'm getting way over if you feel that you're getting way over in your head as far as what I'm talking about in terms of deltas, gammas, thetas, vegas, we do have a webinar separately on option Greeks, which I highly recommend that you go and take a look. But again, that's why I said in the beginning, this is a more advanced webinar. It's only for those of you that have a little bit more experience trading options. But that gives you a sense for what you're trying to do here, because what you're doing when you're selling a straddle is you're hoping that the stock doesn't move very much, meaning volatility doesn't expand. You don't have a big move in the underlying stock that causes volatility to expand. What you're hoping is that it's not that you're hoping. Time decay is going to work in your favor on a short straddle, and you actually get double the time decay. And all you're hoping is that the stock doesn't make a big move, and that delta basically overcomes what you're gaining here on these two. So you can think of the short Vega and short theta as positives for your strategy. And the delta, if the stock doesn't move, then delta is also going to work in your favor. And that's how you get a positive trade. And that's how you get a profit at expiration. So at expiration, if the stock doesn't move, then delta is working in your favor, or it's not working against you, rather. I think what's a more accurate statement for if the stock doesn't move is that delta stays neutral. So you just basically remain neutral, and what you're gaining here is Vega and theta. Now, if the stock makes a big move, what you're going to see here instead is that you're going to have, you're going to have volatility and theta work in your favor, but delta becomes much, much larger and offsets the gains that you have from Vega and theta. So that's what happens when the stock makes a big move higher or a big move lower, and that's when you have losses on this particular strategy. Does that make sense? Again, please type 2 if that makes sense to you. And for those of you that are asking, is this going to be recorded? The answer is yes. This is an advanced topic, so we always make sure the recordings are available along with the slides so that you can follow along and take it at your own pace. Maybe go back and do some reading on the Greeks, understand Vega, theta, and delta, and then come back and try to understand these concepts again. So effectively, the way to profit from a short straddle is if the stock does not drift too much to offset the gains that you have from theta and vega. That's the goal of selling the straddle. Now, when should you generally go about doing this? When we talk about selling straddles, meaning when you sell the at the money call or put, the exact same strike price as the current price of the stock, this is generally suitable for stocks that are generally lower priced, under $100. You don't generally want to sell straddles on stocks like Amazon that are trading at $3,000, $3,500. You want to do it on low price stocks. The other thing that you want to generally look for is high IV rank. We're going to come back to this and talk a little bit about what high IV rank is, but it's really looking at the implied volatility of an option, looking at how it's currently trading with respect to the range of IVs that we have seen over the past year, and you're trying to sell options that have high IV. Basically, what you're targeting are stocks that have really high vega, because something with a high amount of implied volatility has a higher probability of moving lower implied volatility. Because you're short vega, you want volatility to come down. So if you want volatility to come down, you naturally want to find stocks where volatility is elevated. The more elevated implied volatility currently is, the higher the probability it's going to come down. That's how you get vega to work in your favor. Theta is always going to work in your favor. And then your goal is that if you can maximize the vega part, which means that you have a higher chance of this coming down, you know theta is going to come work in your favor, and what you're hoping is that delta does not exceed the gains that you have on short volatility and short time decay. So that's why we generally seek something with a high IV rank. And then what you're trying to do is you're just trying to collect as much of a percentage of the stock price, because in this example here, we're collecting 8% of the stock price. So when you're collecting 8% of the stock price, that means the stock can move up to 8% one way or another before the strategy is profitable. So if instead of collecting 8%, if you collected 10%, then the stock has to move 10% before the strategy is unprofitable. If you collect 15%, then the stock has to move 15%. So the higher the IV rank, generally speaking, the larger a percentage of the stock price you're going to collect. And the larger percentage of the stock price you collect, the bigger buffer you have from taking losses on this type of strategy. And lastly, you generally want to target stocks that have no earnings or catalysts that are coming up. Because if you have an earnings coming up in a few days, that is the catalyst that could drive that stock to move significantly higher or significantly lower. Now, there are some professionals, there are plenty of professionals, I would say, that actually do like selling strangles going into earnings. And those are usually based on, multiple factors of them believing the stock's not going to make a big move on earnings. And they're effectively trying to look for stocks that have elevated implied volatility. Now, stocks generally do have elevated implied volatility going up into earnings. Now, if you have other models that show you that you don't think the stock's going to make a big move on earnings, that is one way that you can do it. But I generally recommend for most investors that are starting out with this type of strategy is to target stocks that don't have a catalyst coming up when you're shorting a straddle or a strangle. Does that make sense? Please type 3 into the chat window if that makes sense to you. Okay, so let's now talk a little bit about a strangle, which is very similar in nature, but also at the same time quite different. So what we're doing here is the same thing. We have a neutral view on stock XYZ, but instead of selling an at-the-money call and an at-the-money put, what we're going to sell is an out-of-the-money call and an out-of-the-money put. Now, when you sell an out-of-the-money call and out-of-the-money put, what you're going to do is you're going to collect a lot less. So before we're collecting $4 on each side. Here, now I'm only collecting $2 on each side. So what I'm going to do is I'm going to limit the amount of potential profit that I have on this trade. So now instead of potentially making $8 on the trade, I'm only making potentially $4 on this trade. But the offset that I'm doing is the fact that when I'm selling an out-of-the-money call or put and I'm collecting less capital, I'm actually widening out the break-even price here, because I'm basically going from 95. Sorry, this is incorrect. This should say 91 and 109. I apologize for this. This should say 91 to 109 because I'm collecting $4 and my break-even price is $95 minus $4 or 105 plus $4, which is 91 and 109. So I apologize for this. I will correct this before I send this out. But as you can see before, what I was doing is that I was collecting $8 and my break-even price is 92 and 108. Now I'm collecting $4, but my break-even price is actually even further away because I'm selling that out of the money strangle instead of a straddle. So you basically have the same risk to reward ratio as you have before. Now what you're doing is you're collecting less premium, but you have a larger buffer. The stock can move a larger amount before you're unprofitable on this type of trade. Now, there's quite a few differences here also as well when it comes to this type of strategy. Now, from a strangle perspective, you have the same short volatility and short theta as you do on a short straddle, but the one thing that is quite different from a short straddle and a strangle is that you still start out delta neutral, but as a stock drifts higher or lower, the changes in delta happen actually a lot slower because you're not selling an at the money call or a put. So as the stock moves away, you immediately start to have that delta exposure on one side. Here, the stock needs to move a significant amount before your short put or short call becomes in the money, and that delta starts to play a factor in this. So the delta drift is much smaller. So you really focus a lot more on the short volatility, the short vega and the short theta part. You're just collecting less premium and it's happening at a slightly lower pace. But the offset is the fact that delta is going to drift much slower, okay? Now, when we're talking about a short strangle, this is really where you have, this is generally used for stocks that are a little higher. So stocks that are over $100, but also you also don't want to sell strangles, generally speaking, on stocks that are over $500. Number one, it just requires a large amount of capital. It also has a large amount of risk, right? Because a $500 stock going to zero is going to hurt a lot more than a $100 stock going to zero. So unless you have a very, very sizable account, generally speaking, we tend to find that when you're selling strangles, you do it on a stock that's anywhere from $100 to $500. Anything greater than that, you're going to find that the margin requirements are too high. Anything lower than that, you might find that the premiums are not quite high enough that you might want to sell a straddle instead for stocks that are under $100. But you still want to do it on stocks that have high IV rank, meaning you don't want to do it on a stock that currently has relatively low volatility. And you also want to try to collect as large of a percentage of the stock price as possible, because the larger the percentage that you collect, the wider the break-even price on this strategy is going to be. And for those of you that are looking at this type of strategy, you might notice that selling a strangle looks kind of like a butterfly, because that's exactly what a butterfly is you're selling the strangle, and then instead what you're also doing in addition to that is you're buying a lower put and buying a lower call so that you don't have unlimited risks to the downside, that you limit your risk to both sides. So that's how a butterfly is effectively constructed. And then a strangle is similar in nature to an iron condor or some type of condor, because that's exactly how an iron condor is constructed, because what you're doing is you're buying that out of the money call or put, further out of the money call or put, so that you don't have unlimited losses. You actually limit your losses here to the downside. So that's part of why I'm introducing straddles and strangles here, so that we can then take this education and take it to the next level, which for those of you that perhaps you don't want to take on that unlimited risk factor, you can turn it into a butterfly, you can turn it into an iron condor for those of you that like to trade that strategy. But the underlying trade that you're making when you're trading a butterfly or a condor is actually a short straddle and a short strangle. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. But the rules for the two strategies are very similar. You generally want to do them on high IV rank stocks. You generally want to collect as large of a percentage as possible of the stock price. And you generally want to do it when there are no earnings or catalysts on the calendar. So catalysts outside of earnings are things like if a stock is about to do a big product release, right? That might be a catalyst that could have a major impact on the stock itself. And I'm thinking about things like when Apple announces that they're going to launch a new product and they have an event scheduled for it, or if Tesla is putting out their battery day, a big event like that. Those are the types of things that you want to look out for and avoid when you're selling a straddle and strangle, because those are the types of events that can potentially move the stock substantially higher or substantially lower. Okay, so let's just take a look at like when should you sell straddles and strangles, and this is really where I think a lot of investors, when you look at a chart, it is obvious for a lot of investors to say, hey, a stock that I've noticed has been trading in a range for a while. I think this is a good time to sell a straddle and a strangle. And intuitively, that makes a lot of sense. You've identified a stock, it's trading in a range. Let me sell a straddle and strangle. And many times that's what I hear from investors who say, hey, I've identified a stock, it's trading in a range. I think I want to sell an iron condor. And I can't help but just, again, reiterate, when you look at a chart and you look at when do stocks tend, when do stocks tend to trade in a range like this, they usually tend to follow big moves, meaning after the stock makes a big move, that's when we tend to find consolidation ranges or consolidation periods after which a stock trades within a range. So it's actually when you've identified a range, rarely is that actually a good time to sell a straddle and a strangle. If anything, at the end of by the time that you've identified the stock is trading with the range, that's actually when it's more likely to have a bigger move. So what we tend to find is that stocks that make big moves are the ones that are more likely to trade sideways. As you can see here, when you have these big moves, you tend to have stocks that trade sideways. It doesn't work all the time, right? Sometimes the stock makes a big move in one direction and then immediately reverses in the opposite direction. This is by no means an exact science, but this is certainly something that I have noticed as a technical analyst myself. And another way that you can analyze this, another way that you can look for these is at the bottom here, I have a chart of the implied volatility. Now, this is JP Morgan Chase. It doesn't really matter what time frame this is. This is the implied volatility here chart of JP Morgan Chase. And as you can see here, for the most part, it trades within a range of somewhere between 35, 36% to the upside and about 15% here to the downside. So what IV rank measures is where is the stock within this particular range. So I put a bar here, I put a line here at the middle. So you can consider this middle as IV rank of 50%. That's exactly what IV rank 50% means. It means that what is the low that we've seen over the past year? What is the low and what is the high? And what is the middle of that? So if it's between 15 and 35, that means this middle line is drawn somewhere around 25%. And what you want to do is you want to identify when JPM is above 25%, when the IV percentile or IV implied volatility is above 25%. The reason for this is because these spikes that you see are generally after the stock makes a big move. And after the stock makes a big move, these are generally times that you may see stocks trade in a sideways fashion. It doesn't work all the time, and sometimes when you get a big move to the upside, IV is actually at the lower end of the spectrum. But from my perspective, that's still an opportunity to sell. But here's another one where you have a spike here in the implied volatility, and then the stock trades sideways. Here's another spike that you see. But as you can see, the stock doesn't trade sideways. It moves substantially higher here. So this is not something that is going to work every single time. But generally speaking, you're going to find that after a big move, you have a higher probability of the stock trading sideways rather than the stock. When after you've identified a range, that's when it's least likely to actually continue to trading in that range. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. So one of the best ways to try to identify the optimal opportunity to sell a straddle or a strangle, which at the end, if you want to, you can turn into a butterfly or a condor, is to look for stocks that have exceeded their 50% range here. So when you're looking at a page like this, this allows you to identify opportunities when you want to sell that straddle and strangle on this particular stock. So what we have created here at OptionsPlay is what we call an at the money straddle report. Now, this is something that I'm currently still tinkering with and I'm still working on improving, but this is something you have available to you here. Whoops. This is a report that you can have access to. We are in the process of adding this to the platform so that everyone can have access to it, but I'm giving everyone here on this webinar early access to this report. And the way that this report works is similar to the credit spread report that many of you are currently leveraging in your trading. And what it does is it tells you, it sorts it based on how much premium you're collecting as a percentage of the stock price. And it also tells you IV rank and earnings date. Now, what you see is that stocks that have the highest amount of premium that you're collecting. So for example, Plug Power, it's a $65 stock, but the 65.5 straddle, meaning the at the money straddle, is collecting $21.35, meaning the stock has to move 33% in one direction or another in the next 45 days, roughly, before this strategy is unprofitable. So let's just plug this in here. Plug Power at 65.35. Notice how this was after a big move here already. Now, Plug Power has actually been on this report here for a few days, but let's see. Let's go to neutral, short straddle, sorry. Short straddle. We'll do the March 5th, 65.5 straddle rather. As you can see, the break-even price is 43.50 or 87.50. So just to put that into context, 43.50 is down here, and I probably have to zoom in to get to 85.50 here. So 43.50 is around here, and 87.50 is up here. So the stock would have to exceed that level or go below that level by March 5th in order for this strategy to be unprofitable. If it's anywhere within this range between 43.5 and 87.5, that's when this straddle will be profitable. So this report is something that we're still working on to try to improve and provide, you know, kind of the best scenarios for you to sell a straddle or strangle on. Now, the thing about IV ranks is that it's a very crude and very simple calculation. And in turn, there are some limitations. And the big limitation that we generally have with IV rank is the fact that in the month of February during the coronavirus, normally volatilities look like this. During the coronavirus, we had this huge spike, which kind of derails the upper bound of the range, which normally would be down here or so. Whoops. Normally, the upper bound of the range would be somewhere here, but because of the pandemic, we have the upper bound of the range over here, which means that normally, you know, you would, what would be a normal range would look like this, and the 50% rank would be somewhere here. Now the 50% rank is somewhere over here. So you need a much bigger spike in implied volatility to get it above 50% in terms of IV rank until February of next year. So this is just kind of, just to give you a little bit of an understanding of kind of how the sausage is made in the background, but IV rank, which normally is a good measure in normal times of when implied volatility is high or low, we tend to find that this has been skewed a little bit, again, because of the pandemic this year. So anything over that 30% now, I would say, is on the higher end of the spectrum here. We do have to make that adjustment until we get past March of 2021, when we can, where the high implied volatilities from February and March are basically taken off. Then we go back to more of that 50% range here for IV rank. But right now, Plug Power, for example, is one potential candidate. You have quite a few that are coming up, but they have earnings coming up. So February 4th. So, you know, Pinterest and Snapchat, high IV rank, but earnings are coming up. Plug Power is one that doesn't have earnings coming up until March 4th. You have two Chinese, Chinese electric vehicle companies. Now, the one thing is that right now we don't have IV ranks on some of those names at the moment, but another one that we have is DBX, but that also reports earnings fairly quickly. Chewy doesn't report earnings until April, relatively elevated implied volatility. PDD doesn't report earnings until March 10th with very high IV ranks. These are all opportunities to potentially look at. Now, again, what we're still working on is getting the strangles up out there in terms of this type of report, but this is something that I'm working on actively this week. I'm hoping to continue to improve this so that we have access to this for everyone, so that you can have access to these types of reports. And we're going to continue to improve them. And we're going to probably sort out some of these low IV ranks. So for example, we'll probably remove some of the really low IV ranks and just show you the high IV rank ones and show you where there are opportunities to sell straddles and strangles, like for example, Facebook. Now Facebook is a high price stock, so I probably wouldn't sell straddles on this, I'd probably look to sell strangles on this. So those are some of the adjustments that are coming up, but I wanted to share this report, everyone, so that you can see it. Another way that you can look at this is looking at the liquidity report, right? The liquidity report is something that you all have access to on your OptionsPlay platform. When you click on the liquidity link here at the bottom of your screen, that gives you this report. And what you can do is you can sort that report by IV rank. An IV rank will tell you when a stock is coming, what the IV rank currently is, and when the next earnings date is. So Baidu, relatively higher price stock that doesn't report earnings for another 28 days. PDD doesn't report earnings for 41 days with relatively high implied volatility. Logitech, another one with a relatively high implied volatility. Facebook, some of these, EDU, same thing. So we have some names here that allow you to potentially find these types of opportunities. And again, we're going to continue to improve this report so that we have better access to these types of opportunities for everyone. But for everyone here on the webinar, you get early access so that you can start taking a look. So let's talk a little bit about the optimal strategy here. So generally speaking, whenever we're selling straddles or strangles, we generally go out roughly about 45 days to expiration. And when you're a straddle, then it's just very easy. You sell the at the money call or put. If you're selling a strangle, this is really where you have quite a bit of wiggle room. You can sell anywhere from a 15 to 30 delta call or put. Now, as far as which one you sell is really dependent on how much risk you're willing to take. The further out you go in terms of deltas, meaning the wider your strangles are, the less risk you're taking, because the stock needs to make an extreme move before you're unprofitable. But the further out you go, the less potential profit that you have, the less max reward that you have. The further out you go, the less premium you're collecting. Does that make sense, everyone? Please type 6 into the chat window if that makes sense to you. I see some people saying that the link does not work. Let me just check that real quick. Okay, I will take a look at that and try to fix that for everyone before we finish here today. I know it's a link that should work, but I will. Oops. That shouldn't be the case. I'm not sure why that's happening. Anyone with the link? If that does not work, I will make sure that I fix that. Okay, I'm gonna fix this before we finish here today. Let me just finish this and I will get back to making sure that that link works for everyone. But like I said, when you're selling a strangle, you have a pretty wide wiggle room. Selling a 15 delta is pretty far away from the current price of the stock. It gives you a lot more buffer before the strategy is unprofitable, but it gives you much smaller potential reward. If you sell a closer to the current price strangle, a 30 delta, for example, you're going to get a smaller buffer, but you're going to collect more premium, so more higher potential reward here. But when you're trading straddles and strangles, there's a main difference here between managing these two strategies. Number one, when you're selling a straddle, like I said, the delta drift starts to play as a factor against the short call or put, the short vega and theta in your strategy much quicker. So when you're selling a straddle, you actually have to take profits very, very quickly. Generally speaking, you're actually only holding onto a trade like this for about 2 weeks. So you're going from starting out about 45 days, and generally speaking, within 30 days to expiration, so about 2 weeks time, you're generally going to be taking profits. And for those of you that sell credit spreads, you're familiar with taking profits at 50% max gain. But when you're selling straddles, you have to take profits very quickly at about 25% of max gain is generally speaking the optimal time to take profits on a straddle. When you're taking a strangle, because you have a lot more room, that deltas, even if the stock starts to drift a little, you're not going to start seeing significant decreases in P&L as a result of it. Those for strangles, you tend to hold on to them for a little longer, closer to 3.5 weeks. And for those, you're going to take profits similar to credit spreads at 50% of max gain. So the management of the two strategies to when you want to take profits is going to be different. On straddles, you want to take profits quickly. On strangles, you have a little bit more wiggle room and you can wait for a little bit more premium collection before you take profits. As far as managing losses here, this is really where, because of the fact that these strategies have unlimited losses, you want to make sure that you keep a very tight lid here on when you choose to cut your losses here. So when you have a 50% of max gain of a loss, so let's say you collect $8 in premium on a straddle, once you lose roughly about $4 on this trade, it's time to start cutting your losses and moving on to the next trade, because you're only you're taking profits at 25% of max gain. When you've lost 50% of max gain, it's time to cut your losses. And generally speaking, if you're going to roll this type of strategy, so if let's say you sold something for $8, it now trades at, let's say, $6, and you want to take profits, that's when you can roll the strategy to the next 45-day option. But what you want to do is you want to do it so that you roll it to another 45-day straddle or 45-day at the money straddle. Again, once you choose to either cut your losses or take profits, either one, you can roll your strategy, but you want to roll it to another 45-day at the money straddle here in this particular scenario. Now, in a strangle here, you have a little bit more wiggle room here. So you have, so let's say in this particular case, you sold the 95 and the 105 when the stock was trading at 100. So what you have is the option of when the stock, let's say you sell the strangle and the stock starts to move up to the 105, right? So the put side is profitable, the call side is now losing money on this trade. One adjustment that you can make is you can basically roll the $95 put to now a $100 put. So what you're doing is you're buying back the $95 put. Let's say you originally sold this for $2. And by the time the stock drifts up to 105, maybe now this is only trading at, let's say, $1 or maybe even 50 cents. So what you do is you take profit on this $1, you roll it up to 100, and maybe at that point what you're doing is you're collecting another $2. Oops. Another $2 by rolling the 95 to the 100 put. So now what you really are owning is the 105, the 100, 105 strangle here. By rolling up that 95, your new position is you now have a 100, 105 strangle. But let's say you originally collected $2 here on this side as well. Because you've now made $1 on this, you've collected another $2 on this side. So what you've effectively collected now here on this side is a total of $3. And still on this side, you still collected $2. Initially, you collected $4 on this, right? Because you have 2 and 2. Now, because you rolled this side, you took your $1 profit, rolled it up to the $100, collected another $2. Now your total premium you've collected is $5 instead of $4. Now you have a slightly higher buffer than what you had before. Before you had a $4 buffer, now you have a $5 buffer. So that's one way that you can manage this. And you can do this both ways, right? If the stock starts to move lower instead, then you can roll the 105 side up down to the 100. But whatever way the stock moves, you can start rolling the untested side, the side that is profitable, higher. So now what you're going to do is you're going to have a narrower strangle, but you're going to collect more premium, which gives you a little bit more buffer. Now, it's not going to be a night and day, right? Because now you're collecting an extra dollar. An extra dollar is not going to be a whole lot in terms of if the stock continues to rally. Let's say the stock goes up to 120, right? Now, instead of losing before, when you collected $4 and the stock went to 120, you would have lost $16. But by rolling it up, you're only going to lose $15. It's not going to be that big of a difference, but you are collecting a little bit more premium on this particular trade. But at the end of the day, even when you roll this type of strategy, you're not going to have a big move, in my opinion, in one way or another by rolling the strategy. It's going to give you a little bit more premium, a little bit more downside protection, but it's generally speaking not going to be night and day. So that covers what I wanted to share with you here today, just to give you a taste of what selling the straddle and strangle looks like. Like I said, me and my team are still continuing to work on this at the money straddle report to give you better opportunities for selling these types of strategies, but the report gives you a good starting point in terms of trying opportunities, in terms of finding these opportunities. And let me just take 2 seconds and fix that report for everyone so that you can access this report here. So just give me 1 second and I'm going to do that real quick. But in that time, while I fix that report for everyone, I just want to thank everyone for taking the time out here this afternoon. What I'll do is I'll open this up for Q&A. We have both the Q&A section at the bottom of your screen, and there's a chat window. So please bring up your Q&A window. Any questions that you have regarding straddles, type it into the Q&A window, and I'll answer your questions just give me 1 minute to fix that report so that you guys can have access to that real quick. Okay, that link seems to be fixed now. Let me just post that for everyone here one more time. This should now work. Whoops, wrong link actually, I apologize. The second link, the at the money straddle report. So this link on your screen, this link should now work for you to access the report. Perfect, someone just said it works. So let's turn to the questions here. I see a lot of questions, so let's see. Paul's saying, I almost never let an option expire worthless, but many people say that they do. What are the examples where there is zero risk of something happening by Monday? So Paul, I actually recently recorded a video on this. This is a very, very important thing. You know, a lot of investors who sell, you know, for those of you that sell credit spreads, for those of you that sell, you know, if you're selling straddles and strangles, you might find that there are times where there are options that you think are going to expire worthless, but actually especially stocks that you think are going to expire worthless. I just posted a link here in the channel in the chat window. There's a YouTube video. I highly, highly recommend that you guys take a look at that, because that is an example of which, when we had an issue, that was an example where a client had sold the credit spread, had only, a max loss at the time of about $21,000. They thought that the credit spread expired worthless, but because the stock moved after the close on Friday, even though the option expired worthless on Friday, by the time that the market opened up on Monday, the other side of the trade anticipated that the stock was going to make a big move over the weekend because of what happened right after the close, actually exercised the short side of a credit spread. The investor who, for one reason or another, number one, may not have known that they needed to exercise their long options, or maybe did not have the cash in order to exercise their long options, ended up with about a $600,000 loss on a trade that should only have had a $21,000 loss or max loss on a credit spread. So we usually think of credit spreads as a strategy that has limited risk, but in this very unusual set of events caused this investor to lose $600,000 on that particular trade. So this is why we always encourage you, even if you think the stock's even if you have an option that you think is going to expire worthless, you're just going to let it expire because, it's just going to roll off. There's always that slight chance that something happens after the close on Friday that causes someone who's on the other side of that trade to say, I'm going to exercise this trade even though it's worthless, right? You're thinking to yourself, it's worthless. Why don't I, but that person still chooses to exercise because they saw something happen right after the close on Friday. Not a lot of stocks report earnings on Fridays, but sometimes, this was a pharmaceutical stock that had an FDA decision come in at about 4:15 right after the close on Friday. It was based on that news that even though the option had expired out of the money and worthless, that just because something's worthless doesn't mean that someone can't exercise that put or call. Someone can still exercise a worthless call or put if they choose to do so, because it might not be worthwhile or economical on the price at Friday's close, but perhaps they're anticipating where the stock's going to open on Monday and they're choosing to exercise that call or put. So for those reasons, always, 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 when you think something's about to expire worthless, close it out, right? It doesn't cost you more than a penny or two to close it out before expiration. Do it. It's going to save you potentially thousands of dollars if and when you have a big move that happens after the close on Friday. Chris is asking, does IV rank correlate to beta? No. First of all, beta is a very slow moving figure. Beta is calculated over a 5-year period. So is it correlated to beta? Yeah, I guess it is correlated to beta, but beta is not very sensitive. Beta is not going to move on a day-to-day basis. Certainly not very large, right? You generally don't see beta increase in value going into earnings and then collapsing right after earnings. IV rank does. IV rank is a much more sensitive measure of implied volatility. Beta is measured over 5 years. IV rank is really measuring the 30-day volatility. Is there an option level required for these strategies? Yes, level 4 or 5. So depending on the brokerage firm that you have. So yes, these are, again, higher risk, requires higher amount of margin, means that it requires a higher amount of capital, and also requires a higher amount sorry, what was I trying to say? Higher amount of capital, unlimited risk, and requires a higher options level in order to trade these. James is saying, is there a way to manage the trade to keep it delta neutral? James, yes, there is in theory a way to keep it delta neutral, and it's the buy and sell stock, right? So if you short this $100 put and the stock starts to decline in value, what you can do is you can start shorting stock to offset the stock continuing to move lower here. So you can, but it's not something that you have to constantly delta hedge, right? So if the stock moves lower here, you might have to short 10 shares of the stock. If it starts to move even lower, you might have to short then 20 shares of the stock. And then if it starts to move back, you have to then buy back 10 shares of that stock to remain delta neutral. So you can, but it's not something that's easily done, I would say, by most retail investors. Do you roll the untested side of the strangle 45 days to expiration? Great question by Charles. Charles is basically asking, if this trade starts to drift higher and I'm rolling this $95 put up to the $100 put, do I sell a new 45-day put or do I sell the same expiration? So whenever we're talking about rolling the untested side of a strangle here, you're always selling the same expiration that you were originally in. So you're not selling the new 45-day option. So if let's say the 45-day option that you sold is now, 28 days or 30 days from expiration, then you're selling the 28 or 30-day expiration, not a new 45-day expiration. That's a great question, Charles. Naresh is saying, if new additions are made to any of these lists, would it be possible to get alerts? So Naresh, so what we're doing with these types of reports is we're updating them every single hour on the same time every single hour. So for example, with this At the Money Straddle report, they're updated every single hour at, these, as you can see, this was updated at 3:20 here, right before the close here. So this is really how you can utilize this to find this strategy here. So that'll tell you when it's updated. So it's updated on the 20 minutes after every single hour. If I own the underlying equity, does that affect the strategy at all? It absolutely does. So for example, this is a short straddle here that you can see here on Plug Power. If I add the stock, as you can see, what it looks like is effectively a cover call. If you sell a straddle on a stock that you own, your strategy is going to look very similar in terms of risk profile as a cover call, meaning you're still going to have downside risk, but you're not going to have the same upside risk, because when the stock rallies, the losses that you have on the call side are offset by the gains that you have on the underlying stock. So yes, it does affect it. Very much looking forward to the butterfly/iron condor education. I've tried a few of these and like them, but want to know more. So Dean, yeah, absolutely. So in order to understand butterflies and condors, you must understand straddles and strangles, because butterflies and condors are really just short straddles and strangles, but what you're doing is you're buying the out of the money calls and puts to offset that unlimited risk, right? So for example, let me remove the security here. When you're selling a straddle here, what you're doing with a condor and a butterfly, what you're doing here is that you're basically saying that I don't want to take on that unlimited risk, so I'm going to buy a higher call, so maybe a $70 call, and I'm going to buy that lower put, let's say a 59.5 put. And what that's going to do is create that butterfly here. So I think 60.5 is what I need. 65.5, no, 61. There we go. That's how you create a butterfly, right? A butterfly is really just a short straddle, but you're buying those out of the money calls and puts to offset that unlimited risk factor. It does change the strategy completely, to be perfectly honest. But in order to understand that butterfly or condor, you must first understand the straddle and the strangle, because that's how they're constructed. Tony is actually, sorry, I was a little late, but did you cover when the strategy is best used for market timing wise? I did, I talked about it here. So if you want to watch the recording here, I talked a little bit about, from a timing perspective, what you're looking for. Generally speaking, you're looking for a big move. After a big move is when you have generally a higher probability of the stock moving sideways. It's not always the case, but we tend to find that after a big move, the stock tends to make a sideways move. A lot of investors do the opposite. They find a stock that's trading in a range and then they sell a strangle or a straddle, but actually that is the opposite. We tend to find that's when the stock has the opportunity to make the biggest move. Is there is a potential good time to do a trade is just after earnings when less move is expected? In theory, that is potentially one of those cases, but after earnings is usually when implied volatility is lower. So that is not, from that perspective, not the most ideal time. So that might be where that's after when you have a big move. But usually it's not immediately after earnings. It's usually after a little bit after the earnings event, then you have that opportunity. Ramses is saying, I'm new and all I do is naked put and calls. What would you recommend me to do to get to learn the basics? I don't know all the strategies. Ramses, if you're talking about just buying calls or puts, so I highly recommend you follow our YouTube channel. We have a lot of education, a lot of different strategies that can help you get started before you graduate to some of these more advanced strategies. So you can follow us here on YouTube, which is youtube.com/OptionsPlay, which I will post as a link into the chat window. Vincent is saying, you recently mentioned that you have running stop loss orders on all your credit and debit spreads. Can you explain how you select your loss limit on each type of spread? Um, uh, if you're talking about like how do I determine where I place my stop losses or limits? So Vincent, I have videos on both credit and debit spreads on our YouTube channel. On both of those videos, I explain exactly where I want to place my stop losses and my limit orders. So I suggest that you take a time, watch those videos, and I actually explain to you exactly. They're a little different with each one. So, so please watch those videos and you can learn a little bit more. How do we apply straddles to very long-term, like over 365 days? I would not recommend you to do anything longer than 45 days because the whole point of a straddle is to double your short theta. That's really the essence of short straddles and strangles, is you're trying to double the amount of premium that you're collecting and double the amount of time decay that you're collecting. When you sell a 365-day straddle, your theta is virtually zero, meaning the amount of income that you're collecting per day is virtually zero. And as soon as the stock starts to move higher or lower, you're going to start losing money. So you basically have no theta, and yet you have this one thing that can potentially really hurt you, which is the stock starting to drift higher or lower. So for those reasons, never, ever sell a 365-day, 1-year straddle or strangle for that matter. I'm new to these two. Would you recommend one over the other to get one's feet wet? So short strangles, if you're choosing between the two, short strangles has a little less risk involved in them. So that's why I would say between the two, if you're starting out, start on the strangle side rather than straddles. If we expect big movement in a stock, not sure which direction, what is the view about buying a short-term straddle? So here's the thing. I will tell you in the long run, that is a losing proposition in terms of buying, especially a short-dated strangle, because that's really when you have the highest amount of short time decay working against you. Now, here's the thing, is that you said that you think that the stock's going to make a big move, but you're not sure which direction. Unless you're talking about earnings, right? Meaning the stock, I'm not sure what scenario you're in where you think the stock's going to make a big move, but you have no idea which direction that it's going to go in. You're much better off picking a direction and hoping that you're right, because you have a much higher probability of making money on that than you do on a straddle or a strangle, because you're effectively automatically losing money on one side, right? So if you flip this around, if the stock makes a big move this way, you're automatically going to lose money on this side. And you have to overcome losing money on this side and overcoming the premium you're paying on this side. So you're basically putting yourself in a position where you have an almost guaranteed way of losing money in this particular case, especially with 1 week to go. Because all you're paying for is time premium. You're paying double the amount of time premium, and you have to overcome that in a week. So unless you have some, and chances are, if you're expecting a big movement in the underlying stock and you don't know which movement it's going to be, that means there's clearly some kind of catalyst event, right? Earnings coming up, a product release, something like that. That's going to be priced into the market. It's not like, a call or a put is going to cost more if everyone is expecting there's going to be a big move. So for those reasons, buying a call, buying a straddle, buying a strangle is almost never, ever a profitable position, a profitable strategy in the long run. Are there individual opportunities that you can find that you can make money going long a straddle or strangle? Yes, but to do it over and over again to be profitable, I don't think you can pick any one trader that is successful in that, in my opinion. Leonard saying, I recall in a previous webinar we did with Tom Sosnoff, a strangle-like strategy was used to effectively help offset losses from a naked put position trading at 50 delta. I believe the strategy was to sell a 25 delta call, resulting in something like a strangle. Can you discuss further? So sure. What that basically was basically, let's say you didn't sell this 105 call. Let's say you just sold the $95 put. Let's say you just sold the $95 put and the stock starts to trade lower here. What you can do is you can then sell a naked call option and turn it into a short strangle. You're going to collect a little bit of premium, but again, just like rolling this, it's similar to rolling this to a lower premium. What you're doing is you're just collecting a little bit more premium. It's not going to make this night and day, right? Because if the strategy starts to lose money, you're going to lose serious money. And collecting an extra $1 or $2 is usually not going to change the scenario significantly. It's just going to dampen the amount of losses that you have. But that's really what he means, is that if you're just selling a naked call or a naked put and the stock starts to go against you, you can turn it into a short strangle, which gives you a little bit more buffer, right? Usually maybe $1 or $2 more. And then if the stock kind of comes back in your favor or starts to trade within that the range of the strangle, that's when you can start making a little bit of money on that particular trade. But that's really what he meant when he said about like turning a short call or short put into a strangle. Latif is saying, if buying or selling strangles, which delta would you prefer? So again, on a strangle, about 15 to 20, 30 deltas is usually where most traders will trade. Again, the higher the delta, the more premium you're collecting, but the more risk you're taking. 15 deltas, less premium that you're collecting, but also less risk that you're taking. Ursul is saying, hi, Tony, how would you evaluate a short put option given you want to own the stock at a discount? Do you look at the standard deviation or IV? So yeah, you would look at IV generally speaking. I don't, standard deviation doesn't, a standard deviation that's further away certainly would mean that there's a higher IV, but you generally want to look at, you don't want to just look at high IV, you want to look at high IV rank, right? Because something could have high IV because it's just generally speaking more volatile. What you want to do is not just sell something that's more volatile, you want to sell something that's relatively expensive compared to itself, right? So, just to give you just to kind of put it into context, JPM normally has a volatility between 15 and 35, but that's because JPM is not very volatile. Other stocks may be ranging between 80 and 100, right? Whatever that range is, it doesn't matter the fact that something is at 80, but if 80 is a lower end of that stock's implied volatility, you don't want to sell it just because it's 80. You want to sell it when it's higher compared to itself. So that's why IV rank is a measure that we use to determine whether implied volatility is relatively high or low. Also, is weekly option on short put harder to get in and out and exit? So only when an option is newly listed do the spreads get a little wider here, but once it's listed by about 2 to 3 days, you'll see the spreads are in line with pretty much what you see here on the monthly options. So no, weekly options are not harder, in my opinion, to get in and out of. Do you send out alerts when a new idea gets added? Yes. So, Naresh, we send you an email. All members get an email at 6 a.m. Eastern time every single morning with new alerts to either close a position or enter a new position. So if you have a membership, then you get those emails at 6 a.m. Eastern time. I've seen a few conflicting responses regarding closing risk-defined trades, vertical credit spreads within 21 days to expiration. Should you look to close these within 21 days? A recent Tasty Works video said that if the risk is defined, the gamma might be negligible, so it would not necessarily need to close within 21 days if it's out of the money. So Sam, the difference between closing an out-of-the-money credit spread at 21 days versus holding it to expiration is actually marginally, it's roughly the same, which is why we prefer closing it at 21 days to expiration. Because then you can roll that capital into a new trade. It's really more about the mechanical rules around not holding a trade to expiration. And one of the examples that we showed you in the YouTube video is why we generally prefer not to hold it to expiration. You can hold it to expiration. There are additional risks in doing so, but the marginal gains that you have in holding it to 21 days to expiration instead of rolling into another trade and trying to collect premium there, the difference between the two strategies are very similar. And that's part of why what you heard on Tasty Trade is saying it's negligible, meaning, you know, whether you collect the other 50% of the trade by holding another 21 days versus taking profits and then moving on to the next trade and collecting another 50% somewhere else, the difference between the two are negligible. So that's what we mean by that. What's your view on the current state of the market? So Jag, this is something I talked about a little bit on Tuesday. You know, I was talking about just how complacent the markets were. We got that pullback here on Wednesday. So far, it looks like markets have stabilized here. You know, we are in this very tight uptrend here. You know, I basically was talking about how we've been trading against the top of the range bound of that range. We've managed to tag the bottom of this range. We're starting to bounce a little higher here. I think for now, we're back on status quo. We're just going to be trading in this very tight range. This is exactly what we saw here in February of last year, January and February last year, when the markets are grinding slowly like this, higher and higher. And the higher and the more complacent the markets get in this particular state, the bigger the opportunity of a big move here to the downside, or more violent and fast pullback we see here to the downside. So we got a little bit taste of that here on Wednesday. I don't think that this is quite the sell-off that we were looking for. I think this might continue to grind a little bit higher here. I think now is the time to sell cover calls, collect premium, because when you do get an acceleration here to the downside, that is when you need to buy puts. But you don't want to go out and buy puts now. You want to collect premium now so that you can have the premium to buy puts in a little bit. If I have stocks that do the limited risk, if I use the short straddles, I'm not sure that that's a question. If you don't mind answering, rephrasing that. Ray is saying, what TV show is Tony on and what time? It is called Options Action. It is at 5:30 p.m. Eastern time on CNBC every Friday. It's where you can learn a little bit more about the ideas that we have, but more importantly, the option strategies that we trade off of those ideas to take the directional view with limited risk. In your example, your risk was unlimited. How is it better than a spread from a risk-reward ratio perspective? So it really comes down to the premium that you collect, right? So for example, let's just go back to Plug Power here, right? I was showing you how if you sold an at-the-money straddle, let's do straddle here for 1 second. I'm collecting 26 bucks on a $65 stock. If you trade a defined risk strategy, like let's say a short put vertical, let's do something like this. I'm collecting $7.20. So as you can see, a defined risk strategy collects only $7. An unlimited strategy collects more than 3 times that, $26. So the question is really, yes, you have unlimited risk, but if you have 3 times the buffer, in this particular case, a $26 buffer, how far does the stock need to move? And keep in mind, what does unlimited risk mean? Unlimited risk means that if the stock goes to infinity, you can lose infinite amounts of money. But we're talking about between now and March 19th, right? And I will say the whole GameStop thing does change the dynamics of what is the possibility of this stock going to 200, 300. I would say before GameStop, we would say that probability is 0, right? Even if the stock going to $100, would still only result in about a $15 loss on this particular trade. So would you want to take in $26 in exchange for losing $15, even if the stock rockets up to $100, I would say a lot of investors would say, I'll take that risk. I'll take the risk of collecting $26 in exchange for, even if the stock gets to 100, I'm only losing 15, right? Only if the stock goes to 115 do I start losing more than what I'm collecting. So that's really why, someone might want to take unlimited risk. And I think that's a great question. And that's what I was trying to answer here in this particular webinar. Question for later. I was not attentive. Why is it necessary to consider high IV rank stocks? So Angelo, it really just comes down to the fact that when you identify stocks with high IV rank, it tends to be after the stock has made a big move. And that's when you tend to have more sideways action here. So as you can see here, when IV rank is high, this was after a big move and the stock moves sideways here. It doesn't happen all the time, but as you can see here, again, IV rank is high, the stock made a big move, meaning expansions in IV usually are accompanied when the stock makes a big move. After the stock makes a big move, that's generally when you're going to have a higher probability of the stock trading sideways. And that's why selling strangles or straddles during that time when IV is high is what we're going to find a better proposition here for this strategy. Okay, I've answered a lot of questions, but there are a lot more here. Let's see, I'm trying to answer as many questions as I have time for here today. Are you going to integrate the short strangles and short straddles? Yes. So I'm going to have a single report where both straddles and strangles live on the same report. Again, I think it'll be designed where, lower price stocks will have straddles, higher price stocks will have strangles on that report. At any time after a Friday expiration, does the buyer have the right to exercise? Is there an absolute time? So Roger, it depends on your brokerage firm. Most brokerage firms give you anywhere from about 45 minutes to about an hour to exercise after the close. So pay attention to, even if you have an option that expired worthless at expiration, pay attention to the news, pay attention to the after hours on that stock after, if you just let it expire, because something could happen in that window. And not many stocks report earnings after the close on Friday, but Nike did recently. That was an example of which, some people were caught out perhaps by that. Another example is when perhaps an FDA approval or something like that happens after hours on the close. That could be another catalyst. That's actually what happened in Biogen for the customer who lost $600,000. So, pay attention to what happens after the close. If you have options that expired worthless and you think to yourself, I don't have to do anything because at the Friday close it was worthless, think again. Could you show on your website where we go for the link to the straddle report? So we don't have a link on the report on the platform yet, but that's why I'm giving everyone early access through the webinar. You just have to click on the link here on your chat window, which I just posted, which I will just post again here on your screen. So if you go to the chat window, I just posted the link here again. Not sure if your question, when is a good time to buy straddles and strangles? So, you can try to buy straddles and strangles when IV is very low, but again, I can assure you, if you back test that strategy, it is not a profitable strategy in any scenario. How do you ever adjust the trading range slider and OptionsPlay above or below one standard deviation when building a trade on securities that have high beta or high volatility? So Douglas, the trading range simulator already accounts for the high or low implied volatility. So generally speaking, you don't need to make adjustments to it. And if you make adjustments to it, my suggestion to you is make minor adjustments. You never want to make huge adjustments, because what you're effectively doing when you make huge adjustments is you're basically saying the options market and every single other market participant in the world has just gotten the options expectation completely wrong. And you could make that case now with GameStop happening. That market makers completely got the implied volatility of GameStop completely wrong, but largely I would say vast majority of stocks, when you look at the implied volatilities, and this is back tested to over the past 20-30 years, that implied volatility, while not 100% accurate as to what the future volatility is very, very close. So when you make adjustments to the trading range simulator, make small adjustments. So if you think that the option markets are underpricing the volatility, meaning you think there's going to be more volatility than the markets is expecting, make it a little wider, and vice versa. If you think that the markets are overstating volatility, you think it's going to be a little lower than that, make it a little narrower. So that's how you adjust the standard deviations. Why are various cell squares showing highlights with GC next to them in the straddle report? Great question. I'm not exactly sure. I have to go figure that out. I've never seen this before on any of the other reports. So this is one of the things I'm going to go figure out. I think it's because these are people logging in and using it. I'm going to have to figure that out and see what I can do. Oh, yeah. I might have to turn this off just so that we don't see these. I'll have to figure out a way to turn these off. Okay, look, what I do want to do is I don't have enough time to go over everything else, but I do answer every question here. But I do want to do one quick comment just here on GameStop, because I can continue to get inundated with questions about GameStop. And I just want to talk a little bit about what we're seeing, what my views are on this. You know, a lot of questions as to how this is going to end. So I just want to do a quick review of what we see here with GameStop. I did a video here earlier this week just talking about how to analyze GameStop in terms of a trade here. So let me just pull this up and show you what I'm referring to. So GameStop, you know, closed at 197, is now trading at 261 overnight. I mean, I don't necessarily know I need to review what's currently happening. I think most investors here are familiar with what's happening here. Effectively, you have two sides of a coin. You have one hedge fund that has created a very large short position here in GameStop, was very public about it. And then on the other side, you have a message forum, Wall Street Bets on Reddit, that basically is pushing against that short bet and buying a lot of this stock. Now, as far as and trying to create a short squeeze, meaning forcing the hedge fund that is short the stock to have to buy it back and cause them to generate some margin calls so that the hedge funds are forced to buy this back and get out of their short position here. So far, we don't have a clear winner or loser here at the moment here. But one thing I want to point out here is that there seems to be a bit of a balance here that has been tipped in Main Street's favor. So a long time, I think a lot of investors feel that Wall Street is in control. Main Street is usually the one that gets left behind, or Main Street is the one that gets left holding the bag here. And I think this is a bit of a revolution, if you will, that's currently happening right now with GameStop, where you have Main Street trying to tip the balance into their favor. And you know, at the end of the day, we've seen fights like this happen out in the broader markets here. And I think probably one of the most famous ones is Carl Icahn and Bill Ackman on Herbalife. Bill Ackman had a very public, sizable short position in Herbalife, and Carl Icahn decided to take the opposite of that trade and buy that stock and buy a considerable amount of that stock to squeeze Bill Ackman out of that trade, right? So what we're seeing play out here in GameStop is really not that different from that. And you know, this the way that these investors, the millennials in this Wall Street Bets message group, and it's not necessarily just millennials anymore. I think you do have some smart money, some day traders, some professional traders along on this trade as well, participating. But you know, this is something that I think has started pretty much since Occupy Wall Street, where a lot of millennials have felt that things are not in their favor, that they have a general distrust in the financial institutions, in high frequency trading. And this is one way to potentially try to get back at Wall Street. So, you know, I don't think this is anything new. This really stems from a lot of the inequality that we're starting to see emerge and the wage gap that we're starting to emerge in this country. And this is one way to, in theory, play the same game that hedge funds have been playing for a long time with each other, where now it's just instead of one against the other, you have a large amount of smaller investors playing up against, you know, one large or two hedge funds here in this particular case. And there's no doubt that this is market manipulation, or what we would classically call a pump and dump scheme, if there was one party on one side doing this. But because it's not a single party, you have thousands, hundreds of thousands, potentially millions of traders on one side, and there's not one entity doing this, it's hard to put that into the pump and dump scheme category. And also, pump and dump schemes, generally speaking, require falsifying information or distributing false information about a specific stock with the intention of pumping it up and dumping it. This doesn't quite fall into the same category, so it's really hard to categorize this, but it certainly falls under the market manipulation category. But because you don't have a single investor here, it's difficult to kind of to go after. But you still have the same issues that a classic pump and dump scheme has, which is when you acquire a lot of shares at a lower price down here. Whoops. When you acquire a lot of shares, down here, and you see a lot of accumulation in the stock in multiple stages between $40 and about $140 or so, what happens is that when you have this big run up in this underlying stock, unless everyone holds on to this forever and never intends to ever make a profit just to show that they can pump up the stock price, you have the problem of eventually all these people that are invested want to make money on this particular trade. In order for them to make money, they have to sell. And if you bought $10,000 of the stock down here, in order to sell the stock up here, you're going to have to find a buyer that has to spend $100,000 to buy the same number of stocks from you. And the question is, at what point are there no more investors left willing to spend the $100,000 to buy the stock that you bought for $10,000 a couple of weeks back? So that's the problem that we currently find ourselves in. And the question from a lot of investors is, how does this all end? And that's a really good question. And from my perspective, there's really two ways that this could end. One is regulation comes in and tries to stop this. And to some degree, we've already seen regulation, not from the government entities, but regulation from the brokerage firms, preventing individuals from continuing to buy this stock. That's one artificial way that you could potentially end this per se. I don't think that in itself is going to end well, because if you stop the buying in this stock, that doesn't stop them from pumping up a different stock. And it becomes a cat and mouse game. So if you just keep stopping people from buying stocks, that's never going to work. So I don't think that's a long-term solution. I certainly think it's going to anger a lot of investors that want to buy the stock that can't do it. The second one is really regulations comes in and for one way or another decides to prevent retail traders from buying out of the money call options or speculating in this particular way. That also I don't think is going to end very well, because that's just artificially stopping something, and that's likely going to come back and bite us in the ass with a vengeance. If you stop retail investors from trading this, they might end up trading something different that's less regulated, but that doesn't stop the movement from happening. From my perspective, really the only way to correctly potentially stop some of this, if you will, and I'm not sure that stop is the right thing that you necessarily want to do, is really rethinking how how options are priced. So for example, before the 87 market crash, calls and puts were roughly traded at the equal amount. So if you bought a 25 delta call or 25 delta put, they were priced roughly the same. But after the 87 crash, what we realized is that markets go down much faster than they go up. So market makers naturally adjusted put volatilities higher. So that's why we have what we call the put call skew, meaning puts, generally speaking, a 25 delta put is going to cost more than a 25 delta call. Now, maybe as a result of GameStop, as a result of some of these stocks that we've seen, we might see a bit of a skew back in the other favor, where there's a higher probability that the stock goes from $20 to $200 in a few days, that market makers simply were not pricing incorrectly. We were still pricing GameStop out of the money options at 150, 200% vol, when reality, it was actually closer to 600 to 700% vol. And market makers that sold those calls had to eventually buy a lot of stock to kind of keep up with hedging their portfolios or hedging their risk. And that created this feedback loop that allowed, relatively small retail investors who are, normally no rational investor would throw 100% of their portfolio in way out of the money call options. But, this group of investors realize that they could create this feedback loop that creates this giant turn of events by buying really far out of the call options, buying a lot of stock, and driving the price up, which causes market makers then have to buy the stock just to hedge their positions, and creating, again, this feedback loop over and over and over again. And that's why we've seen what we're seeing here right now. Now, again, at the end of the day, whether this is market manipulation or not, whether this is a pump and dump or a scheme or not, is, in my opinion, irrelevant, because all the investors that bought here and here and here, unless they plan on holding this forever and never taking profits on their trades, which, if you look at the message boards and you see, all the comments about, I'm going to be able to pay off my student loans, I'm going to be able to start my own business, I'm going to be able to do X, Y, and Z with this, those things are all great, and I support that if you're able to make that kind of money in the markets, right? Especially if you're able to make it legally. And largely what they're doing is not illegal, in my opinion, or certainly doesn't fall into the clearly being illegal. The problem is that in order to take profits, to pay off your student loans, to start a business, to do X, Y, and Z, you have to sell. And the question is, who are you going to sell to? Largely, it's going to be other retail investors, and it's still always going to be the investors that got in early that are going to be the ones that get the ability to sell at a profit. Everyone else that gets in later in the game is going to have to be the ones that buy this stock. Otherwise, immediately when someone down here that has tens of thousands of shares sells immediately, it's just going to blow through all of the bid prices and drive the stock down immediately. So for now, as you can see, looking at this chart, there's very little volume here. So very little selling, very little buying. First of all, no buying because the brokerage firms have stopped the ability to buy, but also no selling at the moment. So that's why the stock is currently still trading at these elevated prices. But the second anyone chooses to hit the exit, that's really where we're going to see that crash here. How long can these investors continue to hold this for? How long? How much capital is there behind a message board with 4 million users behind it? I don't know. You don't know. No one knows. This is what we're all trying to figure out right now. But they have managed to figure out a way to leverage their capital through option market makers that have to hedge their positions and have successfully been able to drive the stock this high. But again, the problem is someone has to sell, and the second that starts to happen, it's going to create that effect down to the downside. So for those reasons, I think that this is just a cat and mouse game here in the meantime. And the one thing I will comment, a lot of these investors currently feel that they have more opportunity to squeeze the stock higher because they see that the short interest on the stock is still very high. But I will say, for those of you that are thinking that you haven't squeezed out the hedge funds, think, and I'm not saying that the hedge funds have or have not covered their short positions. They very well could have, they very well could not have. But the one thing I want to remind investors is that you don't have to cover your short position in order to close out your position. So a lot of investors feel that to close out their position, they have to cover their shorts. As a hedge fund, as a sophisticated hedge fund, there are many other ways that you can close out your position without covering your short. You can buy the stock, meaning you can have a short and long stock position at the same time. There's nothing that stops you from doing so. So you could effectively be hedged and out of the position, but not have to cover your shorts. You can also cover your shorts using options. The hedge fund themselves could be long these options, or long a forward, or long a swap, or an OTC derivative that they're hedged with. There are lots of ways that a hedge fund could, in theory, synthetically close out their positions without actually covering their shorts. So that's one thing. That's another thing that we need to remember. The hedge fund that initially shorted this position can now be massively long without having to cover their shorts. There are a lot of ways that a hedge fund could get themselves out of this trade without closing their short position. So those are some of the things I want to just get out there, because I've gotten so many questions here over the past few days regarding this. I hope that this was helpful in giving you some light as to what's currently going on, how this is all going to end. I certainly hope that this doesn't end by some heavy-handed regulation that comes in and stops retail traders from trading options. But I can't help but think that there could be something like that coming down the line. So I just want to let people understand what's currently going on, what's going through my head, and hopefully giving you some insights into how this might all play out. So with that, I just want to thank everyone for taking the time out here this afternoon. I hope that this was helpful in giving you a better understanding of straddles and strangles and also what's currently going on with GameStop. So please, if you're watching this on YouTube, feel free to leave a comment below. I'd like to hear as far as what your thoughts are and what's currently going on at this market, how you think this is all going to resolve itself. And please hit subscribe to our YouTube channel so that you can stay up to date on anything that we put out here in the future. Thank you so much. I hope you guys have a great evening, and I'll see you guys here tomorrow morning.